Amid the oncoming slew of big bank earnings, the chart master says there is one name that has maybe looked a little too good for too long. Carter Worth is at the plasma to tell us what it is.
So I wanted to focus on JPMorgan, the darling. We prefer things like Goldman Sachs, frankly, Morgan Stanley, catch-up trades. But let's look at JPMorgan and maybe make the case why it is overdone at this point. You can see the chart, no judgments, annotations by me. Now let's focus on the breakout. And it's a textbook breakout, right? You can draw your lines this way, an ascending wedge, but the point is well-defined tops at a common level and a breakout. Now, once a stock breaks out, whether it's a semi or a bank or a retailer, how far can it go? It can go forever. But there is an old technique called a measured move. You take the width of the range. This traded in a range for 2 years before ultimately breaking out. And if you look closely here, the width of this range, $88 is the Christmas low, 114, 114, 114. It's a $26 range. Take a look at the next slide. $26. A measured move is the width of the range from the point of the breakout. We touched exactly $140 on Jan 2nd, and we stopped dead cold. My hunch is that this is overdone, and you want to play laggards rather than a stock like this that has already sort of met its objective. And as you guys were speaking earlier, it is reaching a price to book that makes one say, Here is, of course, JPMorgan versus the BKX. Since 2009, a 10-year chart. It's a double. And then just banks in general, and this is kind of the issue. What do we know? If I draw a line here in January, and I draw a line here, the BKX has made no progress. I mean, banks as an aggregate, as a theme, as a bet, and they peaked right after the presidential election. It's where alpha goes to die. Maybe this gets better, but after the last 2 years, no results, unchanged absolute in a big bull phase, a disaster on a relative basis compared to other choices one could have made.
All right, Carter, why don't you come on over here, guys, and let's talk more about this here. I mean, he's not, as you said, Lori's looking at the chart. He's not making a value judgment initially, but he looks at the charts and says, this is what I think. What do you think?
Well, again, I go back to, is this potentially signaling something about the broader market as a whole? And I do happen to think we're a bit overdue for a pullback at this moment in time. Now, I am also sensing that investors really do want to find the relative value calls right now. Investors we talk to think stocks are overvalued, and they're trying to find things that haven't run up quite as much. That? Yes. I mean, we did a survey.
So are they selling, or are they just, it's overvalued, but I'm going to still own them?
Well, we did a survey on this in December, right before the holidays, and we actually found that most of our clients were bullish, but they still thought stocks were overvalued. One of the things we found is they're very, kind of bullish on valuations. There's a lot of liquidity sloshing around the system. People think the Fed might be goosing things a bit. But just to get back on the financials, we are sensing that people are saying, okay, things have gotten a little overheated. Where have things not gotten quite overheated, and wanting to play the rally that way?
Dr. Worth, I mean, let's put your psychiatrist, behavioral economics hat on. You heard what she said. I mean, people... I believe it's overvalued, but I'm not going to sell it.
Right, but I don't want to quit, right? And it's ever thus.
I can't quit.
I can't quit, right? Or my cost base doesn't allow me to quit. I don't want to pay taxes. That's the nature. And we also know the clustering in big names, Apple and Microsoft. So much does depend on the financials, and the valuations in many names are reasonable. The case for JPMorgan seems like that's been the crowded one. That's the Apple, that's the Microsoft financials. I'd rather do something American Express, looks like a breakout coming, whereas JPMorgan already broke out, or a MetLife. There are all sorts of good names within financials.
Yeah, and I would just say, I'm not going to defend, sort of the leaders so far. I generally like the idea of laggards at this point. I think that's where investor appetite is.
So speaking of laggards, Tim just mentioned the regional banks. If you look at the KRE, the index that tracks them, it had that breakout. It's been range bound. I think late August, it touched $48. It traded almost 60. Now it's come back and it's trading like 57.5. It is sloppy, and you didn't get the breakout. And what does that mean to you?
Well, first of all, that's a sort of different kettle of fish. There are very good regionals and super regionals, but as an aggregate, the KRE has been a very unhappy proposition, and I just wouldn't do it.
I want to read something from Morgan Stanley and have somebody comment. This came out today from their wealth management division. And I got it and I read it and I thought, this is really sort of a bluntly honest assessment of the markets, maybe, if you believe it. Here's what Morgan Stanley said today. Comparisons with the 1999 stock market compelling. Complacency indicators are high. Valuations on nearly every risk metric for the index are above their averages. Compressed risk premiums leave little room for investment. Consider rebalancing your portfolio quarterly instead of annually. Trim passive exposure and selling extreme outperformers. So even Morgan Stanley.
Are you sure those aren't Dan Nathan's notes?
Yeah.
I mean, from
Thanks, Dan. This is Morgan Stanley Wealth Management. This is what Morgan Stanley Wealth Management is sending out to all their RIAs and all their clients. And they're basically saying the markets are wildly or close to wildly overvalued.
Well,
This is not like some guy in his basement with a blog.
No.
No offense to that guy. I like him.
I mean, look, that's what makes a market. They're always buyers and sellers. But we all know that sometimes you get into a period where it's just almost frozen in autopilot up. And that's what this feels like. Complacency
Is that what the
is a
charts
great
look like
risk.
to you, Dan?
No, I mean, the sentiment is dumb. The price action is dumb. All the points that they just littered in that paragraph, they all make sense. But right now, nobody's taking them seriously. And this feels so much like January 2018. I can't tell you. And I know there's a lot of people are going to give you a lot of reasons why it's not. But it also feels like a lot of other times in my career over the last 20 years where indiscriminate buying, especially the concentration in the names that we're seeing, it won't end well. And it's going to end sooner than later. I'm not telling you we're going to crash and this and that, whatever. It's just not going to end well. No one can even see a 3 to 4% pullback. That means you're going to get 2x that, or maybe worse. And it's going to take like January or 2018. It took 10 months to make a new high once we topped out. Those are the conditions that are ripe right now.
You look at Gene Munster of Loop Ventures, frequent guest of this show. He wrote in his blog today, not in his basement, he wrote in his blog today that Tesla is probably all short covering, and it's likely going to have a very sharp pullback at some point, or at least history says that kind of stuff. How risky are things right now?
They are, and the point you're citing, and point in time, that January of 2018, we're on the 2-year anniversary of that. The transports are still below that level. The BKX is below that level. The materials are below that level. The energy, I mean, it's all dependent on this Apple, Microsoft, if you name. If there's any trouble in paradise, and these darlings ever have a setback, market cannot sustain it.
Okay. I think that's an important conversation.
Trouble in paradise.
People are writing in, they're adding us. Is this the bear version of fast money?
Adding us.
They're adding. I think this is just the realistic version.
No, but valuations matter.
Right? I mean, it's the realistic version.
Valuations matter, and it always comes back to valuation. And I think we've made that.
And everything is earnings growth. And by the way, earnings growth is expected to fall.